Hi, I'm James Robinson, and this is my stock pick of the week. This is my fourth video on the company SEI Investment Company, symbol SEIC. Today we're going to talk about the company's dividends and the safety of those dividends. So here you can see a chart of dividends per share. You can see that the dividends have gone up really pretty steadily every single year. There's a couple of bumps in the road during the recession of 2010, but not a big deal. You can also see that the dividends per share have gone up faster than the dividends. That's of course because the company's been paying dividends. They've also been buying back shares, and so the same amount of dividend dollars, which is on the slide on the left, is being spread over fewer shares. So the slide on the right will show that the dividends are going up faster than the amount of dividends actually being paid. It's yet another benefit of buying back shares. But just looking at a company's dividends doesn't tell the full story. If you're going to really be a dividend investor, you want to know just not only what are the dividends and how fast are the dividends growing, you want to know how safe those dividends are. So I look at that in four ways. I think there's four ways to measure how safe the dividends is. The first thing, obviously not measurement of safe, it's just the facts. What is the yield and how is the yield growing? So we'll talk about that briefly. Then we talk about dividend safety in the context of earnings. So what you want to see is a dividend. If a company's paying more than 100% of its earnings in dividends, those dividends are artificial, they can't be sustained. Conversely, if the dividends are very, very tiny relative to earnings, then that company has the ability to raise dividends significantly, or they need to be demonstrating they're doing something else very efficient with the cash, or I start to get nervous. The management doesn't care about me as the shareholder. I like to see a comfortable, sensible dividend with sensible increases that's not taking up too much of earnings, but also isn't too little of earnings. I also look at dividend safety in the context of cash flow. Cash flow tells a lot of the bodies are buried and are uncovered by looking at the cash flow statement. So we look at that as well. And finally, look at dividend safety in the context of its current debt load, because effectively a company oftentimes in times of stress will have to choose between paying its shareholders or paying its lenders. And so if the company has too much debt, then that makes it very easy to choose not to pay the shareholders a dividend and instead to pay the interest in the tough times. If the company has no debt or very little debt or very little interest obligation, then they don't have that decision to make and they can continue to pay dividends through the rough times until things get very, very rough. So that's what we're going to look at in terms of SEI dividends. So here, this chart, the orange bars represent the amount of increase, and the slide on the right side of the slide, you can see the amounts. So basically, it's been north of 6% every year for the last 4 years, and you can see the dividends obviously going up reasonably dramatically. The yield for this stock is about 1.22%. The S&P 500 average is 1.73%. So if I didn't love everything else about this company, I would say that this is a sort of a negative, or it's not a disqualifying thing, but I certainly wouldn't be buying this stock if I was a dividend investor looking for a retirement account, for example. This is a company that I'm looking to grow earnings and grow value over time, and I'm not really worried about the dividends. And as we talked about in other slides, I'm really not that upset that they don't pay dividends because they get such a fantastic return on retained earnings, and they're also buying back a lot of shares. So dividend growth has averaged about 8.4% in the last 5 years. So call it 2.5 times the rate of inflation. So if you were a dividend investor and you were counting on this, you'd be getting a raise relative to inflation every year, which is nice. I think there are better stocks if you're simply a dividend investor. But it's solid and it's consistent and there's nice earnings increases that are outpacing inflation. So this slide, what we look at is payout ratio. And payout ratio is just saying what percentage of the earnings are being paid out to the shareholders. And again, if that number is too high, it's a red flag. And if it's too low, it bothers me a little bit. So the payout ratio for the company is 20.1% this year. The average payout ratio is 21.5%. So just to put that in context, the S&P 500's average payout ratio is 40%. And the S&P 500 aren't great dividend payers in the first place, right? There's a lot of companies that pay no dividends in that cohort. So I'm not excited about this. And this is the kind of thing that would make me not like the company, but because I do research on so many different facets of the company, when you look at this in the context of the return on retained earnings and the fact that they're buying back shares, if they pay me back dividends, yes, I have some cash, much of which I might be willing to reinvest in the company, but the cash that I got, I had to pay taxes on. If they simply buy back the shares, I get the same benefit of having more stock, and I didn't have to pay taxes on the money, so that makes sense. Also, this company's getting a better than 10% return on retained earnings. So the yield is 1%. I don't really care about that. What I care about is that the money that they keep, I'm getting effectively a yield of 10% on that money that's reinvested, or better than 10%. So The payout ratio of this company is very, very low, but because I believe so much in what the management is doing with the money that they don't pay me in dividends, I have no problem with it at all. But there would be companies that I do have a problem. Dividend safety in the context of cash flow. I think this needs some explanation because some of this isn't intuitive and a lot of people haven't seen this kind of stuff before. So cash flow is actually the money that came into the business. And you can hide and you can fool with and fudge earnings, but you can't fool and hide cash flow. There has to be cash that's accounted for in all of this. So the company had cash flow from operations of $545 million. They had capital expenditures, that's money they had to invest back in the business, of $77 million. That left them $467 million of free cash flow. Now, free cash flow is the cash that you took in that you can choose to do whatever you want as a manager. So they had $467 million of that. They paid $100 million of that to us, the shareholders, in dividends, which is a dividend relative to cash flow of 21.5%. You can see that it's always been in that range. It's very close to the payout ratio that they got in terms of earnings because they don't have a lot of capital expenditures. So this is very, very much in the safe range. There's no reason to believe that the dividend would be in jeopardy as a result of it being too high a percentage of cash flow of dividends. Sometimes you'll see that this number will be over 100%, and that becomes very unsustainable. This company is very sustainable. You could make an argument that this company could pay a lot more money in dividends, but again, I'm so happy with what this company is doing with the money that they're not paying me in dividends that I don't really want them to do that. I'm very happy having this stay exactly the ratio it is. So normally I would do a video, or a slide I should say, on dividend safety in the context of debt load. But this company really has virtually no debt. It has $50 million of debt juxtaposed with $500 million of annual earnings. So they could pay off their debt in a month if they wanted to. So I don't think that the dividends and the safety of the dividends and the sustainability and increase of dividends will ever be impacted by this company's debt. That's just not going to be a consideration. So I'm not going to do a slide on it. So in summary, we have a company that pays, the dividends are going up. The dividends per share are going up faster than that. The company is, the dividend yield is 1.22%. That's significantly below the S&P 500, so I don't think I would buy this company as a dividend investor if dividend income was my primary goal, but it's not the end of the world that it's so small. If you did buy it because you like the dividends have been increasing by 8.5% a year, so that's pretty solid, more than twice the rate of inflation. The payout ratio is very low, 20%. We could see this company pay more in dividends, but we don't really want them to. It's been consistent for the last 5 years. It's about half the rate of dividend payout ratio for the S&P 500. Dividend safety in the context of cash flow, same kind of thing. Cash flow is very high relative to dividends, so the dividends are very, very safe. So that's it for dividends for SEIC. Please remember to subscribe, to like, and to comment. Thank you.